everybody. We're at the top of the hour here. At the end of August 26th, office hours. So we'll, as always, give everyone a few minutes to shuffle in here, and then we'll get started here. All right, everyone. As to be consistent with the past couple of office hours, we'll probably be on the shorter side here. Last week of summer, so hopefully, those of you who are unable to attend, you're out there kind of enjoying what's left. So for you, some of our members here are have dropped off their son or daughter at their school, or some are preparing to do that. So congratulations. Hope that goes well. Quite the achievement. So congrats to you and the student. So we'll kind of quickly touch upon those families who are in that position, and then we'll really start to also talk about those parents who are getting ready to kind of embark on this journey. Those kind of rising seniors that for some of you, I know you've reached out and kind of the hair's on fire, and that's totally fine. We're going to kind of talk about some things to consider at this point for you rising juniors and rising seniors and underclassmen. So as always, this is kind of the live open forum Q&A. Please feel free to throw any questions in the Q&A. We will get to those throughout the next couple of minutes here, and then we'll kind of spend some time on each of those kind of categories here. So quickly for the class of 2021s who are kind of getting ready to go to school. At this point, you kind of cross the finish line. The tuition bills for the first semester likely have been due and been paid in one form or another. If there are any kind of issues that pop up that you need some guidance on, please feel to drop any questions in the Q&A here or via the community. But at this point, bills are paid for the first semester. And as you well know, and this will be a good kind of education for those underclassmen, in terms of being billed by the school, you're billed per semester. So, the first semester bill of the fall usually is due in and around August 1st, again, school by school basis. And then the second semester bill will be issued in and around end of November, early December, and it's school by school, but typically that is due in and around the same time. So when you're looking at these kind of net costs and these the payment schedules, it's done semester by semester. So as far as the class of 2022, and even for those that are, even further, have a longer path, sophomores and freshmen and juniors, what we want to start to really think about at this point is kind of honing in on your strategy. Okay, so what do we mean by that? So the first starting point that we recommend for every family going through this process, whether you are on the very needy side or whether you're on the very affluent side, is understanding kind of your eligibility for need-based aid. Okay, that's kind of the starting point, for better or for worse. And one of the features that you get in terms of our membership, along with kind of the education, is obviously your access to College Aid Pro. And College Aid Pro will, once you're kind of logged in and you've put in your kind of base facts, your income, your assets, that sort of thing, what you'll notice at the top of the screen is we're going to auto calculate your EFCs, your expected family contribution numbers. Okay, so that ultimately is what dictates your eligibility for need-based financial aid. And if you've seen any of our workshops, kind of that's where we begin as well. And your eligibility for need-based aid is essentially taking the sticker price of the school, which is the cost of attendance, minus your family contribution number, equals the need that your family is eligible for. Okay, so it's important to understand that at first, because if you do have eligibility for need-based aid, then you want to hone in on colleges that are excellent with giving out that type of money. Okay. And on the flip side, if you are a family who is not eligible for need-based aid, okay, it doesn't mean that you're shit out of luck. It just means that you have to switch some strategies around and even be a little bit more strategic. So when we're able to rule out the eligibility for need-based aid, we can cultivate our kind of college search to hone in on where we will see discounts, and that's with merit scholarships. Okay, and again, the software College Aid Pro is going to allow you to, one, understand your eligibility for need, and then two, go shop for schools with that strategy in mind. So you can search for schools who are easily, or rather, you can easily filter for schools who are excellent with need-based financial aid, or you actually can search for schools who are very likely to offer your student a merit scholarship. What I'll do is I'll pull up the software here just as a tutorial, but let me take a second here. We've got a couple of questions coming in. All right, so we have a rising senior and a junior. Okay. It's been a while since I wrapped my head around this, but now I'm back at it. All right, it's good to have you back engaged here. Okay, confused about how to access the recordings from previous office hours, and can you remind me of the software about entering income before or after taxes? Okay, and this happens to be a business owner, sole proprietor, and the question also is around, are we entering before business expenses or after? So I'll quickly hit on that last point here. So the income figures that you're going to use is off your personal federal tax return. Okay, so whether it's W-2 income or whether it's business income, that's where you're going to get that information off your personal federal tax return. So if you're a rising senior, your class of 2022, you're using the 2020 tax return. So what you'll see on there is what you've reported on your 1040 as your business income. And typically that is netted out after kind of your expenses. Okay, so that's what you're going to be using right off of your 1040. Now, a couple of things it's noteworthy to talk about business owners, and just something to keep in mind. So there are some private schools, okay, that for the most part, let me take a step back. So for the most part, these colleges, public, private, they're going to look at sort of that top line figure, right? So your 1040, and what was your business income? However, what you can expect to happen at these private schools, they're going to request your corporate returns, or your full federal tax return. And there are some cases where some of these colleges, if they want to be really difficult, they'll look at some of the business expenses and they won't honor those. So they'll take some of those expenses and add it back to your adjusted gross income. Okay. Now this isn't common practice, okay, but it can happen. And we've seen probably a couple dozen times this past year where this has happened. So it's something to be aware of. And we're going to be talking about it quite a bit as we kind of move forward in this process. And that's why it's great. We can leverage kind of College Aid Pro. Here's what we could kind of expect. And if we get financial aid awards that, and you happen to be a business owner, if we get financial aid awards back that really aren't close to what CAP projects, likely that is the area that we'll examine, or you'll want to examine in an appeal. So for example, we had a client last year, business owner, moderate income on the 1040. And, we were expecting a very good student applying to some pretty prestigious universities. And, we kind of set the precedent like, hey, listen, there are going to be some of these colleges, and based on our experience, we know some of the colleges who are kind of a pain in the neck, to put it very nicely. But, they're going to, look at the business and scrutinize it. And, we'll just be at the ready to engage in that conversation if we feel like they kind of, didn't honor any of these expenses. So at a couple of these, elite private schools, it played out exactly how we were projecting. But there was one, which of course happened to be the top choice of this family. The award came back very underwhelming. So, we kind of were expecting it at some level. So through the appeals process, what we were able to do is, call them out and say, hey, listen, explain to us, why we're seeing such a difference, and explain to us, how you treated the business expenses. So we were able to actually reverse engineer what they did. And what they did is they didn't honor some of the depreciation on their business tax return or their Schedule 1. And then they added back a couple of expenses, and we kind of called them on that, and we had to kind of show proper documentation, but they reversed their decision, and they actually modified the award tremendously, and their award ultimately landed based on kind of pretty close to what we were expecting right from the go. So this is a story not to scare anyone, but this is one of those kind of behind the scenes practices that is not well known by some of these private schools. They have some of these tactics, some of these strategies, for lack of a better word, that they can use to under award families, to offer them less money. So again, this is something we'll revisit quite a bit, especially as we'll be talking about self-employeds quite a bit. Something to just keep in mind. But to your question, you're using kind of the net business income that's shown on your 1040. Okay. So let me go ahead and share my screen just as kind of a refresher for those kind of rising seniors who are kind of starting to re-engage here as the beaches are closing up on us, unfortunately. Let me see here. Okay, so unfortunately, there's two logins, right? So to get the content, the recording, things like that, you'll go to our main website, ineedfinancialaid.com. You go to member access, and you'll go ahead and log in here. Let's see if I can, hopefully this works. There you go. So this is kind of all of the content. This is the office hours recording, the weekly updates, things like that. You can find them all here. Okay. Now, to get into the software College Aid Pro, it's a separate login. So the login that you use to get into this kind of members page and the content is going to be probably different to get into College Aid Pro. So if you haven't set up your account, you can go ahead and create your account here. If you already have one, you can go here and log in. Okay. So and this actually gives me a good opportunity to kind of like share an update. So we're officially kind of merging with College Aid Pro. So within the next, I want to say, 2 months, we're going to revamp the platform, and that way it's going to be kind of a single sign-on. So you'll have the ability to have access to all the recordings, to even more education. We're building out kind of what we call the academy. So you'll have on-demand videos and things like that. And then you'll also have full access to your College Aid Pro account. So that's coming. So we know it's a little clunky having 2 logins, but that's kind of what we had to sort of deal with to kind of get us out of the box here. Let me see. Here we go. So your interface is a little bit different. This is kind of the advisor side of things, but this gives you a good understanding of how you're going to operate. So as you can see up top, like I said, there's your EFCs, right? So there's 3 different EFCs. There's one that's the federal methodology. That's what the FAFSA only or the public schools will use. You have your institutional. This is the EFC that most private schools will use. And what you'll notice here in this situation is that it's much higher because private schools will factor in the equity in your primary home as an asset. So if you have a large amount of home equity in your primary home, likely your institutional methodology or your institutional EFC will be much higher. And then we have a consensus methodology, and really the consensus methodology is a subset of private schools. I would kind of dub them as a subset of elite private schools, where they more or less follow the institutional, but they have limits on home equity. So if you're a family that has moderate income, but has a lot of equity in their primary home, and you have a bright student, a strategy for you might be to hone in on schools who use the consensus methodology. Okay, so again, it kind of reiterates the point, understanding what your EFCs are right off the bat, because that's going to dictate how you go shop for schools strategically. So you're going to enter your base facts. You have your earnings. That's kind of your earnings from work. You get all of this can be taken from the 1040. Okay, there's notes here as well to walk you through, so that way you're putting in the correct information. Your adjusted gross income, income tax paid. If you have retirement accounts, you're going to put in your assets, your home equity, things like that. And then that's what's going to translate to the EFCs. And what you'll see, they're pretty dynamic here. So, if for some reason you went back and you updated that you have $600,000 in investments, they're going to update in real time. Okay, so and what you'll also notice too, if you wanted to put in, your retirement accounts, you don't have to. Retirement accounts are not part of the assessment. So even if I have 7 million in an IRA, it's not going to change my EFCs here. Okay, so making sure the data is correct on the way in here. You also want to make sure you put in the GPA and the SAT scores, and also when the student is going to graduate. And then also, if the student has a major in mind, go ahead and put that, because once on kind of the output, we have some projections in terms of outcomes based on the major that the student is going to be taking. And then I want to quickly spend some time on the pre-approval page, because you see these three numbers here. These are what the colleges think you could afford to pay. But what the pre-approval is our way to kind of drill down on what is actually realistic that your family can afford to pay per year. So it's kind of a separate exercise that helps you build more or less your college budget, right? So, if you have 529 just for that particular student, go ahead and put that in. If you're still contributing and $100 a month, and there's 12 months until it's time to go to school. Pledged assets. This is, assets that the parents own, not the 529, certainly not retirement accounts, but checking, savings, or other liquid investments that you're willing to pledge to pay for school. And what we're looking for is a 4-year total here. So if you kind of spend some time thinking about it and you say, okay, we could do $10,000 from our, mutual fund each year, that's $40,000 over the course of 4 years. Cash flow. This is basically income. So money comes in, money comes out every month. Is there any money from income that you can put towards paying for college? Okay. Sometimes that answer is zero. Sometimes there might be a surplus there that you could say, okay, we'll do $250 a month just from income. Okay. And that starts to add up over the course of the 4 years. If you're eligible for the tax credit, we're going to automatically present that to you. So the opportunity tax credit is a credit you get if you are you meet the adjusted gross income thresholds, which is unless they've recently changed, is 160,000 and below, you'll get the maximum. But it is scaled. I think the cutoff is 180,000. So what we say is, okay, you're going to get a $2,500 tax credit if you're able to. Don't use that to go on vacation. Just put that back towards paying tuition. Students' assets, students' cash flow, a lot of times that's zero. And if you have, any relative help or expecting grandparent help, now is the time to have that conversation. So, and what we're trying to do is drill down on, okay, without any borrowing, in this situation, we could afford a school that's going to cost us $35,000, $36,000 a year. Okay. So it's a very useful exercise to do early on in the process. And then we can go shopping for colleges, because again, if you're a family that's, looking to really be mindful of the student loan kind of debt that you have, this is going to give you a good barometer that hopefully we can find some schools that will cost us, in and around this each year. Okay. So this is when you can enter your schools. And what we're going to do quickly is give you kind of an estimated first year net cost. You can also go in and use the advanced search. And this is where you can really drill down, especially if you are a family who potentially is not going to be eligible for any need-based aid. You can sort things by merit scholarship. So the system will let you know, okay, there's a very good chance that you're going to be eligible for a merit scholarship, okay, at these schools. And you can go ahead and add those schools as you see fit, as you build this out. So, we're big believers in having a healthy balance in terms of your school list. You don't want 10 schools on your list that are going to cost you $70,000, $80,000 a year. You want to have options here. Okay. And then if you drill down, or if you want to drill down on the school specific, this kind of gives you how they run from an admission standpoint, financial aid, and then what you'll notice is outcomes. So what we want to try to do is business majors at Boston College, here's kind of an expectation in terms of what their salaries are. And we added this piece of it because what we try to do is caution anybody, if there is borrowing that is required on top that is above the starting first year salary, you want to just take a closer look at that and make sure it's worth the investment. Okay. So if for some reason that the first year net cost at BC was, below the first year net salary, you'll find, it might say good, great, ideal. Okay, so what we would just want to do is educate folks, and early on in this process, to understand kind of what kind of financial fallout potentially will be down the line. And then what you'll notice here, we have a database of every merit scholarship at every single school. So you can kind of go down here and look at all the merit scholarships that are available. Sorry, that was kind of a long-winded answer there. Let's see here. So we have a question: consensus methodology, is that schools that utilize the CSS profile? So the consensus methodology is a group of, I think it's like 30 schools that they utilize the CSS profile, but then they have their own kind of rules in terms of how they kind of calculate their EFC. So I wouldn't say the CSS profile is the the indicator, right? Because pretty much every private school, there are exceptions, will require the CSS profile. The majority of them use the institutional methodology, but there's some that utilize the CSS profile to capture the information, but then they have they kind of have their own methodology in terms of how they use that data. It's very, very similar to the institutional methodology, but two of the really big kind of differences are how they value student assets. Consensus methodology, they value student assets at a much lower rate, I think closer to 5%, whereas the institutional methodology values student assets at 20%. And then obviously the home equity is typically capped and limited at the consensus methodology. All right, let's see here. Okay. So we have a question regarding kind of assets and how they're reported on the financial aid forms, which become available October 1st. First thing I would say is you don't have to complete the forms on October 1st, okay? As long as you meet your priority deadlines, you're entitled to any and all of that money, okay? And I always kind of share this that, everyone thinks, okay, if on October 1st, I complete my financial aid forms, I'm going to get more money. That's not true. And also everyone's rushing and flooding these websites, and the FAFSA crashes the first week or two of October. Always, when you go in there, it'll just boot you off because of they can't handle all the traffic. So you don't have to drive yourself crazy going and doing this on October 1st. But with regard to assets, assets are technically reported in real time. So what are in your accounts the day you go to complete the FAFSA, complete the CSS profile? Now, there are situations where, from a timing standpoint, you could time it up. And, if you have, if you have some major expenses coming up and those accounts will be drawn down quite a bit, technically you can kind of hold off on completing the FAFSA and CSS profile until those are drawn down, and then prepare those forms. So as long as you meet the priority deadlines. But sometimes the timing doesn't work out. So the way I would kind of coach this up is if you're expecting a very large expense, in this case seems like there's a kitchen rental, I would complete my forms as if that money has been drawn down already. Okay. You got to do what's right for your family, and this is not a perfect process. There's a lot of flaws. So if you think there's going to be $50,000 less in that account, it just so happens that won't happen for a couple of weeks or a couple of months after you complete the forms. Do what's best for your family, and that's how I would coach that. Now, as far as verifying assets, right? The way that colleges verify the assets that you report on the FAFSA on the CSS profile is they will very likely request your tax return, your full tax return. And what they'll do is they'll see on there your taxable interest or your dividends, and then what assets kind of produced those amounts. And they'll look at what's on your forms, look at the interest, and they have a calculation and say, okay, yeah, this makes sense. So let's say, for example, and this happens, quite often. Let's say at the beginning of the year, you had a sizable asset in there, and you're going to show a couple $1,000s in taxable interest or a couple $1,000s in ordinary dividends. But at the time that you completed the FAFSA, that money was no longer there. Okay, that happens. So what will happen sometimes is you complete the FAFSA CSS profile correctly, but the colleges, they will look at your tax returns, and if it doesn't match up, they can either make a change themselves, or they'll ask for further documentation. So again, that's just something to keep in mind, because if an award comes back that doesn't look right, that might be the reason why they made a professional judgment, and they said, okay, well, they reported they had zero in investments, but we're seeing a $10,000 dividend on their tax return. So that's kind of when you would have to issue an appeal, explain that away, and then likely what will happen is they'll readjust the award. But that's how the kind of process unfolds. Let's see here. So again, a self-employed question. If I had a C Corp and I leave some money in my business instead of taking that as income, is that a strategy? So yeah, we can definitely chat more on this, but having money in a business is definitely it's better to have it within the business as opposed to in your personal account, because technically business assets are not assessable. Especially, definitely at the federal level. If you have less than 100 employees, you report zero for business assets. So leaving money in the business is definitely beneficial than having it in a personal account. With regard to income, right? So 2020 already happened. So unless you haven't filed yet, like me. So, like I said before, ultimately you're judged upon your personal federal tax returns. So if you have the ability to defer compensation, defer income, and it doesn't show on your personal return, that's going to be potentially advantageous. Now, there's a lot of moving parts, right? To do any of these kind of strategies, you have to kind of look at the whole picture. If you were to incorporate these type of strategies, is it really going to be effective? Is it really going to drive down your EFC? Because if you do, you don't want to jump through hoops and your EFC is still negating you from any need-based aid. And school list is a big X factor here. It's different for every single student, and every school kind of operates a little bit differently. And you might have your son or daughter, let's say you live in New Jersey and they love Penn State, and they have their heart set on it, they're going to go there. Unless you're very, very needy, basically Pell Grant eligible, Penn State's not going to give you any money. And it's kind of a general rule for out-of-state publics, unless you're super needy, and no matter what you kind of do in terms of better presenting the situation, from a need-based standpoint, expectations are very low. However, if you're looking at, expensive private schools with high sticker prices and who are excellent and meet, 90, 95, 100% of need-based financial aid, potentially, you can see a dollar for dollar return on however you lower that EFC. So so business owners have some flexibility there, and it's if you have the ability to kind of keep assets within the business, keep deferred comp, or keep that within the business, it's better than that's showing on your personal return. All right, a couple 529 questions here. Okay, so 529s, am I better off starting a 529 college fund so that it's pre-tax earnings? So 529s are not pre-tax investment vehicles. 529s are, after tax money goes into the funds, but then you can use that money tax free, and you're not taxed on any of those gains. I don't know if that necessarily would be a good strategy this late in the game. You would very likely be, in a very, very conservative 529 portfolio. I don't know if necessarily the gain, you would see much gains. But then you can, if you were to see any gains, those wouldn't be taxed. And then you would use that money tax free. Let's see. So part of the question was, should I contribute more to my 401k? So I don't have savings sitting around. So, a common misconception, because, as you kind of get educated here, the adjusted gross income is kind of, the main figure that these colleges will look at. Now, the adjusted gross, the total income figure that these colleges will look at is the adjusted gross income plus any pre-tax retirement contributions or pre-tax kind of contributions. So they'll add that back in. So if you have $100,000 AGI, you contributed $10,000 to your 401k pre-tax, what they're going to do is they're going to look at $110,000 for kind of a total income figure. So lowering your AGI by doing kind of pre-tax retirement contributions, it's great for your retirement, but it's not a strategy to lower your EFC. Okay. Let's see here. Okay, so this is a great question because it's a common mistake. 529s, are they parent asset or student assets? 529s are parent assets. That's how you would report them. That's what they are considered. So parent 529 funds for the student are parent assets. If retirement is not really built out, will they take that into consideration in the appeal? Appeals are very school by school. There's not a standardized framework. For the most part, I would say no, but it is something that I would encourage you to incorporate or include as part of the appeal, because really the appeal process is the way for you to tell your story, the real story. Because of the FAFSA and CSS profile does a very poor job of that, and the assessment on retirement is not included at all at that level. But when you appeal, obviously, it's your opportunity to open up a discussion, kind of explain the real situation. Hey, you saw kind of the top line stuff on my tax returns, but here's what you really need to know. I would certainly, you want to bring color to the story, and so whether or not the college will completely use that in their appeal kind of decision, but it certainly brings color to the story, and really want to paint kind of the picture of what the real situation is, and the real need is, because the FAFSA CSS profile does a very poor job of that. All right. Yeah, you can Google the schools who use the consensus methodology. Yep, around 30 that changes in and out. And if you Google the, geez, I always forget, the 568 presidents group. It's just a group of that 30-ish selective schools that kind of got together and said, okay, the institutional methodology is fine, but we kind of have our own kind of views on it. The other thing you could do as well is what you'll notice, on the school pop-outs will indicate what EFC that these colleges will use. So that's another way you can see whether or not they're consensus or IM. I think we even put that on the first year report. So if you go to reports, your first year, I is for institutional, C is for consensus. So that's another kind of vehicle for that. So we get a question regarding, the age of kind of the and where that comes into play. Part of the EFC calculations factor in age of the older parent, but it really doesn't move the needle a ton. Parents get what's called an asset protection allowance. So you can have a certain amount of money in non-retirement assets before it starts to move the needle, and that's tied to the age of the older parent. It's not a tremendous allowance. It goes down every year, unfortunately. So that's really the only way it's factored in. But again, that's when you go through the appeals process, which we'll spend a lot of time on that at the appropriate time. It's your opportunity to add color to the story, right? Because we work with a lot of financial aid officers, and what we've been told is that a lot of these folks used to work at the IRS, and it's very easy for them to under award or not advocate for you, because all you are just a stack of papers, right? Your tax return, your FAFSA CSS profile. But when you issue an appeal, you kind of write your letters, you bring color to the situation. Now they get a better understanding, and that gets them motivated to kind of advocate for you and get the real picture. So including age and kind of the retirement piece of the puzzle, that certainly adds color. Well, as we're kind of waiting for a couple other questions in here, what I always like to defer to the tech, and I think it'll be helpful. Now, obviously, you can kind of search for your schools here, but what I find to be very helpful as well, even very early on in the process, is leveraging the how to pay page. So what the how to pay page will do is it's going to pull out and show you kind of a 4-year projection. And I think it's helpful to start looking at sort of a, how are you going to pay for this particular school at this point in the process? And ultimately, what's the financial fallout going to be? So the total loans at, in this case, Boston College, unless we make any other changes, is $232,000. What does that translate into, a monthly payment for a 10-year plan, 25-year plan? And then, what can we expect from kind of a starting salary for a business major here? So, again, this is not to dissuade anybody, but we just want folks to go apply to these colleges with eyes wide open. But what you can see here, it's condensed, and there's a lot going on when you expand these. But what you can see is, what you can expect each of the 4 years and what the total is. And if you do have, and I think one of our comments said that they had a junior right behind, um, they're going to have two in college for 3 years. So what we're able to do is also project out what your additional need-based financial aid is going to be in years, say 2, 3, and 4, because that's going to have a dramatic effect on your need eligibility. So again, you want to plan kind of, yeah, you want to know what's going to cost you the first year, but you want to take a look at what the total is going to be, the total investment compared to your total resources. When you're making these kind of decisions. And then this is the pre-approval. So this is when you could start to build out how you're going to pay for the pay the bill, and it's going to let you know what the funding gap is going to be. So I find it to be a very useful exercise even early on in this process. Something to keep in mind, I just kind of ran into it. There's a reset button on this page. So if you make any changes to kind of your facts on the how to pay page, you'll just have to hit a reset. So it kind of refreshes everything. So this is a much better picture here for Boston College now that we're taking into consideration our resources. So around $100,000 in loans, we still put a caution on that because it's going to be their total loans are going to be higher than the starting salary of a business major coming out of BC. Again, it's just a barometer. It's not to scare you, but it's just a barometer that we've used over the years. And then this is helpful to kind of see and understand how you're going to be paying the bill. So the net cost for year one is around 60. Our system automatically defaults to equally using it over the 4 years, but that's just to get you started. And we'll talk on strategies on how to best leverage these. But in this case, okay, we have a funding gap of $23,000. What we might want to do in this case is we might want to front load the 529, right? And now we're starting to really build out our kind of plan here. So in year one, okay, we only have 3,600 to go. We're likely going to use the federal direct student loan. So we'll use that. And okay, so now we have a surplus. So now we know kind of how we're paying for year one and kind of what that translates to. So this is a good exercise, and you could do it, depending on the school, and you could compare, okay, this is a good outcome, and kind of build out a plan for each of these. So I think it's a useful exercise at the very beginning of this. All right, let's see here. A couple questions coming in. Okay. Okay, so we have an inheritance of part of parents' home. It's probably around 400K. Let's see, can I make the case that money's okay. Okay, so it's kind of a couple of parts to this question: an inheritance, and then what is considered my home. So, your home is kind of where you're living at the time that you're completing these forms, and kind of what is stated on your tax returns. So if you're still renting, then you're going to put yourself down as a renter. Now, as far as the inheritance, you'll want to be mindful when you become the owner of that asset. Okay, if you don't technically own that asset and that doesn't show up on your personal tax return, I would err on the side of not including that. But if you are the owner of that asset, and in this case it's a home, you technically are only on the hook for your portion of the equity. So, if you own, if, it's you're 50% owner of the inherited home, then, and there's, $400,000 in equity, you're really only on the hook for 200,000 of that. And then what I would recommend doing in that case is, utilizing the housing index, which we'll talk about plenty, to kind of try to control or lower the home value, which will lower the home equity and the asset that you own. But you'll want to, just kind of be mindful of the timing around that, and make sure, if you don't technically own that asset when you're completing the forms, you'll leave that off. I'm glad you like the pre-approval budget. I think it's a powerful tool. It's this process is kind of set up to get folks to borrow too much money or overpay for college. It's the only asset that or the only investment where you kind of you go shopping first and you figure out how you're going to pay for it after. And those days, in our opinion, are over. So, just like anything else, you want to kind of what's realistic in terms of what you can resources you have, what's realistic and comfortable in terms of the borrowing you are comfortable taking on, and then shop accordingly. So just to clarify the pre-approval page, it's your pre-approval is for that particular student. So if you have, when we ask about the 529, it's what do you have in a 529 for that particular student? So the pre-approval page, it's built out for, kind of the 4 years. So you're going to put the total that you have in the 529. And then we do the breakout of, what that translates into per year. But on the pre-approval page for that particular student, not, all the 529s that you own, it's just for that particular student, you're going to include the total amount. As far as any concessions for renters trying to save up for a home, so if you're a renter, it doesn't hurt you. It doesn't help you. It's for the federal methodology for the public schools, they don't care whether you rent or you own your home. Your primary residence is irrelevant. At the private schools, however, if you do own your primary residence, they will factor in home equity. But if you're renting, obviously you're not going to have an equity asset there. $529s used for off-campus housing. I don't or can 529 money be used for off-campus housing? Check with your CPA on that specifically, but I'm almost positive that it is you can use that for 529 money for off-campus housing. Technically, to use 529 money without penalty, it's for qualified educational expenses, which I believe off-campus housing falls into that category. Because I think they even have they include laptops, books, things like that. Housing is part of the college experience, whether you're on campus or off campus. So, but I'm not a tax professional, and I think certain CPAs can interpret things a little bit different. So check with your tax professional, but I'm almost positive that 529s can be used for off-campus housing. So when's the latest date to submit financials? I know it's slightly different each year, but in general, what is the end of November? So as far as deadlines, it's really a moving target. There's no universal deadline. Yes, October 1st, these forms become available, but depending on what school your son or daughter applies to, and what forms they require and how they apply, whether they're regular decision or whether they're early action, early decision, will dictate kind of what deadline you have. So the earliest deadline that anybody will have is November 1st. And that's typically only if the student is applying early decision or early action to a private school. Other typical deadlines might be November 15th, December 1st. Usually those are for early action, early decision applicants. Regular decision deadlines are typically January 1st, January 15th, February 1st, February 15th. So, really what we recommend is when you have your college list, and you could leverage the applications page here as well, is to get an understanding of, actually, let me just go ahead and do this, is getting an understanding of what forms are required and when they're required for your particular application. So you can leverage the applications page of the platform as well, just to help you manage and track this. The deadlines are kind of a moving target, so you have to kind of look those up. Okay, let's say we're doing early action at BC. Deadline, you have to look those up in real time because they are a bit of a moving target. We couldn't automate that, but if you hit this, it'll take you right to the appropriate page. You should find the deadline, and then you can kind of go back and put that in there. Again, this is just for your tracking purposes, so that way it's kind of all in one place. And then this will let you know, okay, Boston College needs the FAFSA CSS profile, and then whether they use iDoc. So this page just allows you to kind of keep track of things all in one spot. So hopefully you can leverage that and be helpful. But there's no universal deadline. It hinges on whether you're regular decision, early action, or early decision. All right, everyone, we got a couple of minutes here, but these are tremendous questions, and I love these kind of questions too, because as we kind of shipped off the class of 2021s, we start right from the beginning again with class of 2022. But in my opinion, being strategic and your college savings starts at this point. It's not about college selection and strategy. I think often gets overlooked by some folks, and they get caught up in going to search for schools and rankings and all that stuff. But spending the time on strategy at this point in the process usually lends itself to better results. All right, everyone. I'll, as Matt likes to do, I'll give kind of the countdown here. If not, we'll cut loose. But that was a great session. Thank you for the engagement. Thank you for the questions. It makes my job a lot easier. So going once, going twice. Sold. All right, everyone. So we'll enjoy the rest of the summer. We will see you 2 weeks from now, and we'll kind of keep this going. All right, take care, everyone.